How do businesses secure the funds they need to thrive? This video delves into strategic financial management, focusing on both short-term and long-term funding sources. Discover the essential factors that influence financial decisions and the criteria for choosing the right funding. Financial resources are crucial for business operations. They can be sourced internally or externally. Short-term and long-term funds serve different purposes. Venture capitalists and leverage are key players in funding. Each funding type has its own risk, cost, and control implications. Short-term finance covers daily business operations. It's less risky for lenders due to quick repayment. Long-term finance supports bigger projects with longer payback periods. Mortgages and bank loans are examples of long-term finance. Each type serves distinct business needs. Businesses must assess their financial needs carefully. Consider how much money is required and for how long. Determine what security can be offered. Decide if control can be shared for investment. These factors guide funding decisions. Overdrafts and short-term loans are common. Overdrafts offer flexibility but can be withdrawn anytime. Short-term loans have fixed terms and interest rates. Both options provide quick access to funds. Businesses must weigh flexibility against security. Working capital is vital for daily operations. It balances current assets and liabilities. Effective management minimizes insolvency risk. The goal is to maximize asset returns. Businesses must maintain a healthy cash flow. Bank overdrafts allow businesses to overdraw accounts. They are ideal for short-term financial gaps. Interest is paid on overdrawn amounts. Overdrafts are cheaper than loans if used briefly. Long-term use can become costly. Banks offer various loan options. Clearing, retail, and merchant banks provide different services. Loans are granted if repayment is assured. Banks earn through interest on loans. They also facilitate foreign currency transactions. Partnerships can raise funds by adding partners. New partners bring extra capital. There's no repayment or interest. However, control and profits are shared. This method suits partnership businesses. Limited companies can issue shares for funds. Shareholders gain ownership stakes. There's no repayment or interest. Dividends are paid to shareholders. Ownership dilution is a potential downside. Leasing allows asset use without upfront payment. It's arranged through finance companies. Regular payments are made over time. Leasing is like renting, not owning. It's a medium-term finance option. Hire purchase involves initial deposits and payments. Businesses eventually own the asset. It's costlier than cash purchases. Payments are spread over time. This medium-term option suits equipment acquisition. Mortgages are long-term loans secured on property. They are repaid in installments. Businesses own the property after final payment. Mortgages are expensive compared to cash purchases. Failure to repay can lead to repossession. Trade credit allows buy now, pay later terms. Typical periods are 30 days. It's a short-term finance source. Businesses must manage cash flow carefully. Discounts for cash payments may be lost. Grants are offered by government bodies. They support innovation and development. No repayment is required. Conditions may apply, such as location. Not all businesses qualify for grants. Venture capitalists invest in high-growth potential businesses. They provide capital and expertise. Investments are made in exchange for equity. Venture capitalists seek significant returns. They also support struggling firms. Finance choice depends on several factors. Purpose and time period are crucial. Amount needed and business size matter. Ownership structure influences decisions. Each factor guides the funding strategy. Evaluate funding options based on cost and risk. Consider interest rates and repayment terms. Riskier projects may limit funding sources. Businesses must balance cost with financial stability. Informed decisions drive success. Reflect on your knowledge of finance sources. Rate your understanding on a scale. Identify areas needing improvement. Continuous learning strengthens financial management. Aim for informed decision-making. Explore a business that secured diverse funding. Analyze their strategy and outcomes. Learn from their successes and challenges. Understand the role of strategic finance. Apply insights to your own decisions. In conclusion, being able to recommend effective long-term and short-term sources of funding is essential for supporting organizational stability and growth. Different funding options, such as equity finance, long-term loans, retained earnings, overdrafts, and trade credit, serve distinct purposes depending on financial needs and strategic objectives. By carefully evaluating factors such as cost, risk, flexibility, and impact on control, managers can select the most appropriate funding mix. Sound funding recommendations enable organizations to manage cash flow effectively, invest in opportunities, and maintain financial sustainability. Thank you for watching this video. If you have any questions, please feel free to contact us via email or WhatsApp at 0748436168.